You follow the standard advice. You track every expense, minimize your lifestyle, and consistently move money into a brokerage account. Yet, after months of discipline, the balance seems to barely move. The math of small numbers is working against you. A 10% annual return on a $5,000 portfolio is only $500. While a 10% gain is excellent performance, $500 doesn't change your daily reality. It barely covers a single car repair. In this initial stage, your portfolio is effectively dormant. Nearly all your net worth growth comes from your physical hours and your active paycheck. You are doing all the work, and the money is simply sitting there, waiting for enough mass to become useful. Charlie Munger, the late vice chairman of Berkshire Hathaway, argued that this early period is the most difficult hurdle in an investor's life. He insisted that finding a way to get your hands on $100,000 was a mandatory requirement, regardless of the sacrifices required to get there. This raises a specific question. Why did one of the most successful investors in history focus on this particular six-figure milestone as the definitive turning point? Because $100,000 represents the point where the source of your wealth growth begins to shift. It is the threshold where the annual gains from your capital start to rival your personal contributions, allowing the math of compounding to take over the heavy lifting. The first variable is critical yield mass. To understand it, we look at that same 10% market return, but apply it to a six-figure balance. At $100,000, a 10% move generates $10,000 in a single year. This averages out to over $800 a month in passive growth, enough to cover significant household expenses without touching your principal. Your capital is now generating a meaningful cash flow that rivals a part-time job, yet it requires no physical presence. The money has achieved enough scale to begin manufacturing its own growth. This leads to the second variable, timeline compression. There is a common assumption that if it took a decade of intense saving to reach the first $100,000, it will take another decade to reach $200,000. Looking at the historical velocity of an investor contributing $10,000 a year at an 8% return, the trajectory tells a different story. Reaching the first $100,000 is a slow climb, taking approximately 7.5 years of consistent saving. But because your existing money is now contributing its own returns, the jump to $200,000 takes only 4.5 years. Reaching $300,000 takes just 3.2 years. As the portfolio grows, the time between each $100,000 milestone continues to shrink. The momentum of the capital is effectively buying back years of your working life. Beyond the internal math of the portfolio, there is a third variable, systemic leverage. This is the way the broader financial system changes its behavior toward you once you have liquid capital. When you have very little savings, the system is high friction. You are hit with overdraft fees, higher insurance premiums, and high interest debt because lenders view you as a statistical risk. Holding $100,000 in liquid assets changes your risk profile. Your statistical likelihood of defaulting on a commitment drops, and the banking system adjusts its terms to reflect that stability. Banks often waive maintenance fees and offer access to prime interest rates on mortgages or business loans. These lower costs act as a hidden subsidy that allows your wealth to grow even faster. The most significant change is how you handle the unexpected. A major car repair or a medical bill is no longer a crisis that requires high-interest credit card debt. It becomes a temporary expense that you resolve with cash. This shift creates a sense of financial abundance. When you aren't forced to pay for the cost of being poor, you can keep more of your money invested, aligning your behavior with the strategies used by the ultra-wealthy. The difficulty of the early years serves a specific purpose. It builds the precise level of behavioral discipline required to manage and protect a six-figure portfolio once you actually have it. Every dollar you save today should be viewed as a structural component of a self-sustaining financial base. You are trading current consumption for future momentum. The most frequent error made during this initial slog is abandoning the strategy to chase volatile, speculative gains. Investors often get impatient with the slow pace of compounding and take risks that reset their progress to zero. The blueprint for reaching the threshold is simple, but requires extreme consistency. Maximize the gap between your income and your expenses. eliminate unnecessary subscriptions, and automate your contributions into broad market index funds. Once you establish this six-figure base, the pressure on your active labor begins to lift. You have built the structure, and now you can let the mathematics of the market build your freedom.